Would you describe your investment methodology?
Well, yeah, the Bond Universalis is a multi-sector, unconstrained global bond fund where the objective is to generate a total return, which is not the same as absolute return. It's a total return portfolio which is driven by income realization on the one hand through the selection of various credits and government bonds on a global scale in various fixed income sectors, as well as capital appreciation that we seek when certain elements in currencies like go our way, where we deliver value and realize value, or that credit spreads like tighten, whereby we create value add, or if the direction of interest rates is in favor of our current overall rate strategy.
How you manage your currency exposure?
Well, the overall objective as well of the portfolio is actually to go for a medium realized volatility profile for the fund, and we make use of various risk tools. It's actually the Barclays Point risk tool, which will provide us input on how much volatility is embedded on a portfolio level, and which comes from the various exposures to dollars, euros, and other even more exotic currencies that are present within the fund. Next to the volatility created by our credit exposure, our curve exposure, or even our single name exposure, which is present within the portfolio. So it is actually a holistic approach we take, and once the portfolio is running at cruising speed, we'll track that, be it a value at risk, be it an expected shortfall budget, and the impact that currencies might have on that volatility profile. For the moment, about half of the volatility and of course part of the performance is created by our currency exposure, which is fairly balanced. About a third of the volatility is created by our credit spread exposure, and about 15% is created by our curve exposure, be it in government bonds, be it in global credits.
Why you believe in inflation-linked bonds?
Well, that's a bit of a complicated question, in the sense that we cannot predict when inflation might become an issue. But what we do observe is that from the US perspective, from a European perspective, from a Japanese perspective, and a various list. Well, the list is getting really long of central banks that provide ample liquidity to financial markets and to the real economy, if financial markets allow for a sound allocation into that real economy. So part of the solution of the credit crisis which hit us in 2008 will come from sustained inflation, taking care of the over-indebtedness of the current situation, but also part will be probably part of the solution will go through like a certain default cycle which might be present. But coming back to the inflation element, we all know that back in 2008 inflation-linked bonds behaved very badly as the search for liquidation and monetization of illiquid investments drove a lot of inflation-linked markets to the downside. Fact is that back then you had monetary authorities still with the conventional toolkit present to actually allow to absorb the shock. What kind of toolkit do they have today? Well, it's very different. They don't have the policy rates because they are at zero effectively in Japan and the US, but effectively also in Europe. So if we have a deflationary shock that goes through the system, the only response will be that central banks will respond as aggressively as the deflationary shock because of there's like dropping growth rates coming from China or from the US, and they'll have to use their balance sheet even more in order to stave off I would say the impact on the real economy. So in essence, it's a product which is already scarce, but which will serve as the best hedge in a situation where clearly the use of balance sheets and the use of quantitative easing policies will drive inflation and will support inflation going forward. And again, when it's gonna hit or when it's gonna ramp up, we don't know, but fact is that debt monetization, which we clearly see in the US, in Japan, in the UK, and in parts of Europe, is going hand in hand with inflation. History has shown it. I don't see any reason why, this time it will be different.
What the government bond markets in Europe are telling us now?
Well, in terms of government bonds, we were just discussing it, in terms of, is there value in Spanish and Italian government bonds? We don't have them in the portfolio for the moment, as we believe that the risk premium attached to those markets per unit of risk you have to sustain makes them not valuable in our strategy. We clearly believe that especially in 2012 there was a lot of value in supranational paper, the likes of European Union bonds, the likes of EFSF bonds, and the likes of European Investment Bank bonds. That has lessened quite substantially. So we actually have a tilt towards credit. We still see value from a risk-return perspective in credit, but you have to look at the longer end of the credit curves. Within the current situation and the current growth expectations, we still believe that value is to be captured at the long end of the credit curves. The only difficult thing is that how can you manage a potential normalization of risk-free rates in Germany and in the US? The way we go about is that we build up some credit exposure and spread duration exposure in the long end of sound credits we perceive to be around, and we hedge on the 5-year and the 10-year point to very liquid exchange-traded interest rate futures. And that makes for actually a still balanced duration profile and interest rate sensitivity profile of the fund, but at the same time, go for and realize the value embedded in credit next to pockets of value we see in emerging markets and in various currencies around the world.